Well, President Trump beginning the process of expanding tariffs to cover all $540 billion in Chinese imports. Now, Barclays saying in a note that it estimates direct economic losses of up to 0.3% off GDP over the long run. This is under the assumption that there will be tariffs on, quote, most, if not all, Chinese goods. Mark Hackett, Nationwide Chief of Investment Research, is joining me now. And Mark, when you take a look at what Barclays had to say, I mean, how much have you, if at all, have you adjusted your view in light of the trade escalation?
I think it's a bit early to start putting concrete numbers on the outcome of the trade deal. We're only a couple days old on the $200 billion, and we haven't even seen the details on the remainder. So clearly, if we get those tariffs in place and they remain in place, through, for example, the 2020 election, clearly there's going to be an impact on economic growth. We think that we're still in the formative stages on whether or not that's actually going to be.
Do you think the bounce that we're seeing today, that this is going to be short-lived? Because we've seen the markets basically in turmoil over the last couple of days. We had the massive sell-off yesterday, Dow closing down off over 600 points. I mean, are we going to see more weakness ahead, or could this be maybe a buying opportunity for investors?
I think it's a bit early to declare victory on this. Today's obviously encouraging. We'd like to see the close continue that strength, just for a technical basis. Tomorrow it would be nice to see a follow-through on that. But I still think the market's trying to find its footing. We came into this new round of negotiations with a lot of positive embedded in the markets. We were at an all-time high, and we went from extraordinarily pessimistic assumptions in December to very optimistic assumptions on the trade deal, but also on the expectation of Fed rate cuts, as of just a week and a half ago. I think that it was pretty natural once those facts changed that the market reacted. I still think we're in the formative stages of seeing where we end up with the market. A little too early to declare victory.
Yeah, Mark, would you say that it's fair that if we see a deeper and a quicker sell-off, that almost means that it's more likely that we will get a deal? Because we know President Trump pays such close attention to the markets and really just the overall U.S. economy.
Well, I think that's absolutely true, but also China spends a lot of attention on this as well. You see a lot of the stimulus that they put in their economy last year. That was a direct result of weakness, not only economically, but also in their markets. So clearly, what we've seen over the last week or so is the belief that both China and President Trump think that the strength in both of our economies over the past month or so gives them a little bit more wiggle room in negotiations. So if we see a reversal and we see both markets, but also some of the new economic data start to revert back negative, if we see earnings for the S&P 500 expectations start to inflect back down, I think we might see some change in opinions among the leadership.
Mark, you mentioned the stimulus in China's economy. President Trump was active on Twitter this morning, not anything that's too surprising, but he was basically comparing what China was doing with their economy and maybe trying to pressure the Fed. Do you think that we could see a rate cut here if things don't get better, if we don't get some sort of deal in the short term?
Well, what I would say is a week and a half ago, the market was embedding expectations of both a deal getting done and a rate cut. Those two things don't seem they seem to be a little bit contradictory. If we get a positive resolution to trade, the likelihood of a rate cut happening is extraordinarily low. But if we do see a deterioration in the relationship where it seems that it's going to be 12 to 18 months of this rhetoric and tariffs, it would not surprise us if the Fed reverses course at that point and cuts rates.
Do we want the president pressuring the Fed right now? I mean, what do you make of all this?
I think that the Fed has done a reasonably good job at trying to stay above the politics. It's not totally unprecedented for a president to put some pressure on the Fed. I think the Fed has done a good job of remaining independent. But I think if we continue to have some worries about China and some tariff implications, like we saw, for example, December, January, February of last year and the beginning of this year, those were fundamental deteriorations. If we do see a fundamental deterioration where the economy seizes up or we see another air pocket, it would actually not be necessarily political that the Fed acts. It could actually be fundamental.
Mark Hackett of Nationwide, thanks for coming by today.
Thank you.